Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi, Scalable Investors. Before we get into today's episode, I'd like to tell you about a group that I'm a part of called HiveMind. If you're serious about taking the next step in your real estate investing career, then this is definitely a group that you need to join. Some of our members are making $90,000 or more per month and as much as $300,000 on just one deal. And at the same time, you don't have to spend thousands of dollars like you typically would joining other mastermind groups. This is only $99 per month. And when you join, you'll gain access to a robust integrated CRM software that allows you to track your leads, run automated triggers, and ultimately scale your marketing efforts. So the difference here is that you're not left high and dry, but gain access to a support network that allows you to use that tool and learn from other more experienced real estate investors. So to learn more, go to scalablerei.com/hivemind. That's HIVEMIND. Thanks a lot. Let's get into the episode. Hi, Scalable Investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have Kent Ritter, who is the CEO of Hudson Investing, a multifamily investing group based out of Indianapolis. He's so far invested in 625 doors, $8 million, and I'm sure he has a lot more ahead of him. So glad to have him on the show. Kent, how are you doing today? What's going on?
I'm doing great, Mason. Thanks for having me on the show.
Sure. So before we go down too many different paths, why don't we just discuss your background and what brought you to Hudson Investing and real estate in general?
Sure. You just want me to start at the top?
Sure. Just your journey. Everyone's got their own journey and story. So what's your story?
Sure. So my story begins back in Chicago. I was living in Chicago. I was a management consultant. And that really is how I started my career. I spent 12 years as a management consultant. And I know, like we talked about before we started recording, I mean, you live in that world as well. So you understand it's, flying all over the country, helping big companies solve big problems, right? And through that, you learn a ton about what makes businesses work and what doesn't work. And you start to see patterns on, what are things that make businesses successful. And I think that's been a huge benefit for my real estate investing, both from just a project management standpoint, because at the end of my career there, I was managing multi-million-dollar projects with, fairly large teams of people, and which is similar to a real estate deal, right? Multi-million dollars, and you're managing a lot of different people. And then also just from understanding, what makes businesses work. I mean, at the end of the day, these properties that we're buying, because what I focus on is multifamily and specifically multifamily syndications. And we focus on value add properties, and really what we're buying are businesses that have been cash flowing for 30 or 40 years. And we're just going to help move the right levers to help them perform better and help them improve the cash flow and therefore force the appreciation on the property, increase the value. So that consulting experience has gone a long way. Additionally, at the end of my consulting career, several of my colleagues and I left to start our own business. We started our own consulting firm in Chicago, and we grew. It's a kind of the typical entrepreneur story where we started with 5 guys around a kitchen table and grew that to 95 employees and 30 million in annual revenue. And then in 2015, we decided it was time to sell. And so we sold that business after having a fantastic run. And that really is what set off my real estate career, because I had this capital and I was, kind of saying, what do I do now? Right? What do I do now, both for to keep me occupied, like what's my next adventure? And then what do I do with this capital? Because I know I don't want it all in the stock market, which is where I was all invested at that point. Didn't want to have all my eggs in one basket. So that led me to alternative investments, started researching different alternatives, found real estate, really fell in love with it, did a bunch of hodgepodge things at the beginning until I got some great mentorship and some great education, and really landed on multifamily as the best place that I saw to be able to create value and the best risk-adjusted return that I could find. And then from there, really learned about syndication I said, wow, so I don't have to just go out and pour all my money in a property. And then I'm a landlord, great. And all my money is dumped in this property. I can actually go out and I can pool money together with other investors. We can go buy something bigger and better than what I could buy individually. And in that way, it allows me to diversify and not only spread my own money around to different properties, but also my investors, and really create a portfolio of properties. And so really just an incredible way to invest that I had no idea about until, gosh, probably about 2015. And I was like, man, I wish I would have known about this 10 years earlier. I wish this would have been an option, because I do believe it's the best way to grow your wealth. And it's had an amazing impact on my life. Being able to leave, kind of the corporate consulting job, because after when you sell, you end up working for the people you sell to, right? Usually you don't just get to walk away. So being able to leave that job and being able to just take real estate investing full time. It's something it started out as kind of a very personal journey for me to just say, what am I going to do with this capital? How am I going to continue to grow my wealth? To now, wow, I can grow the wealth of everyone around me. And so that's really why I've started my podcast and meetups and everything else I do, is just try to tell as many people as possible about this type of investing. And you can do these private real estate investments, and I think really change people's lives by giving them just a different level of return than they can get through the stock market.
Okay. How many people that you speak with are even aware of syndications and that they could do something like this?
Like in the general population, very few. People that contact me from hearing me on a podcast or something else, they're obviously aware. But yeah, as far as family and friends or people I interact with, nobody really knows about it. And so I've educated a lot of people, and that's why I do a monthly meetup, and that meetup is all about education, right? It's teaching people about these investments and how to do them right. Same thing with my podcast, which is called Ritter on Real Estate. It's just it's all about the education and helping people, one, understand this is an option, and two, how to do it the right way.
Okay. And the right way, sounds like a loaded term. So what is considered the right way from your perspective?
Well, I guess it depends a little bit on your position, but the right way is really more generally just teaching people how to make the right decisions, how to evaluate deals, how to evaluate deal sponsors, because really the most important thing is the sponsor. A good sponsor can save a bad deal, and a bad sponsor can kill a good deal. And I've seen both sides of it. When I started investing, I first started investing in syndications passively, meaning I was giving my money to someone else who had a deal and was running the deal. And in the second investment I ever made, it turned out to be a bad guy, and he committed fraud, and we all lost our investment. And that was really eye-opening for me, because it made me realize, wow, what did I really do to prevent that? I didn't do the due diligence that I should have done. I didn't really look into the sponsor, and it made me really understand it is really all about the sponsor at the end of the day. You got to find somebody with integrity, somebody with the financial means to sustain a deal. If things, if things are going bad, you got to find somebody who's willing to put their skin in the game, right? Their cash into the deal with you. All of these things are just important, but just this idea of understanding and starting with the sponsor. And then only from there, the right way is, how do you get down into the market? How do you understand if it's a market you should be investing in, if it's a sub-market or a neighborhood you should be investing in? And then only then is it a deal that you should be investing in. So, the right way is a lot to unpack, but that's what we kind of step through step by step, like on my show and in the other education things that I do.
Okay. Interesting. Yeah. I think it was about a year ago from today, I had a prior guest on the show, and he was winding down over $1 billion of assets from some bad deals. It was overall, it was a website that was syndicating different real estate investments, and the multifamily ones were actually the best performing ones in the portfolio. And he was just helping to administer those assets to get the money back for investors. But he did mention some of those fraudulent ones. And also a lot of times single family mom and pops that had raised capital kind of overextended themselves, so didn't have the systems in place to properly utilize that capital and do everything. But that's very interesting. And I'm glad you bring that up, because a lot of times everything's just rosy and great and it's exciting and multifamily is super sexy. And a lot of times you don't really hear about the reality after you write that, or don't write the check, but after you send that wire transfer to the sponsor. So how do you, without like asking for his tax return or her tax return, how do you really vet their financial wherewithal to be able to carry that deal and if shit hits the fan?
Yeah, I mean, it starts with, well, one, I mean, just having a conversation with the person, right? I mean, I believe a lot in your gut and gut feel, and I think that has to be a part of the equation. In the investment I made, which was through a crowdfunding site, I didn't even ever talk to the person. There wasn't even that ability to kind of access who the sponsor was. So I would recommend, one, if you're going to invest with somebody, speak with them, ask them questions, understand how, are they open to answering questions? Does it seem like they don't want to answer certain questions? Do they have good answer? It's kind of like a job interview, right? You're the interviewer. And you need to have a kind of a good script that you go through, and you need to make sure that in doing that, you can get a sense for, okay, is this somebody that I really resonate with? I think also you can find out a lot through social media. I think understanding, is this a person, what are they doing on social media, right? Are they taking pictures on top of Bentleys, or are they, spending time with their family, and what kind of person are they? And different people are going to resonate with different folks, right? One's not for everybody. But for me, if I see somebody, okay, who's family oriented, somebody who has business experience, right? Understanding their past experience is extremely important. I think track record is one of the most important things. Now, everybody has to start somewhere, so it's not always a real estate track record, but at least some sort of business track record, or some sort of understanding, that they're not just coming with no knowledge and no experience and expecting to lead an apartment syndication, which I can tell you is a very complex process and role and thing to do. And so they've got to have some sort of experience. So I think just vetting those things out and getting an understanding. And then, you can definitely ask for referrals. I have people ask me for referrals all the time. Now, I think you have to understand what you're going to get from a referral, right? I mean, nobody's ever going to refer you to somebody who had a bad experience, right? Like, why would anybody do that? No company is going to do that. So I don't think it's like, oh, are they good or bad? Are the questions you ask. I think referrals are more about understanding the process, because a lot of syndicators operate in different ways. I mean, everybody operates in different ways, but it's, how do they communicate? What type of communication? What type of reporting? How transparent are they? Have you gotten all your distributions? And have you gotten them when you said you were going to get them? Have they done any capital calls? Things like that. I think those things are important to understand, and that you can find out through referrals, or through talk. What I mean by referrals is speaking with folks who have invested previously with that person.
Okay. What if they don't have any referrals because it's their first deal? I guess if it's your first deal, though, like, I would personally want to partner with someone. Maybe that partner has referrals, but what do you think?
Yeah. I mean, I don't know if it's somebody's first deal. I mean, you're kind of taking a flyer on them, right? Usually the only people that invest in somebody's first deal are their friends and family.
Yeah,
right.
I agree.
I mean, are you gonna go out and find somebody you don't know and invest in their first deal? Probably less of a likelihood. I don't know that I would do that. You don't really usually want to be the guinea pig.
Yeah, definitely. I mean, it's so true. I hear from tons of different investors. People invest with people that they know, like, and trust. So if they don't know you and don't like you or trust you, they won't do that. So totally understand.
Yeah, I mean, I think every syndicator goes through an evolution of, your first deals are largely your friends and family and colleagues or ex-colleagues or people that you've known throughout your life, right? And they're essentially investing in you. They're not investing in the deal, right? They're investing in you because they know, like, and trust you, right? And then as you evolve and as you develop a track record and as you develop a thought leadership platform, which is critical if you're going to try to raise money from anyone, you have to show your expertise and be out there. If nobody knows about you, it's impossible to raise money, right? Then you go through this evolution of it. It moves more toward folks that are farther outside of your network. And as folks are farther outside of your network, I think those things, a track record, be able to prove, like kind of prove your integrity and other things become more important for people who don't know you from anyone else. You have to find ways to differentiate yourself, right? I had an investor call yesterday, and not enough people ask this. I had an investor call yesterday, and the woman said, so I've invested with this guy and that guy and that guy. What differentiates you from them? And I was like, wow, that's a really good question. Not enough people ask that. And so as you become more mature in your process and get people farther out of your network, I think it's really important to be clear on what differentiates you.
Okay. So not to put you on the spot, but do you mind telling us what you had responded, what you told that woman?
Sure. Yeah. Well, there's a few things that differentiate me. One is our geographic focus. So we very much made a strategic decision to focus in the Midwest. And the Midwest it's my backyard. I grew up in Indianapolis. I lived in Chicago for 12 years, but now I'm back in Indy, and I've got long-term relationships here. I know the area extremely well. I know the different neighborhoods, right? Like the back of my hand, because I grew up here. Everywhere else that we invest is within about 3.5 hours of Indianapolis, because, it's drivable, it's easy to get to. We can get on site and see the property. And we made a strategic decision to do that and focus on the Midwest and own my backyard, rather than trying to just chase the hottest markets out there and go into Phoenix or Dallas or somewhere in Florida or Vegas, where everybody else is going. Because if I'm there and I'm one, it's extremely hard to break into a hot market where everybody else is also trying to break into. Two, then that's not a differentiator. So what I'm able to do now is give people geographic diversification, because they're totally invested in Dallas or Florida or Phoenix, and they can come to the Midwest and they can get that diversification and spread out their risk a little bit. So that's one. Two is just, is my background. I think my consulting background, my experience starting a business, running a business, leading a business, I think that's invaluable experience, both of those things that have translated extremely well into making my real estate career successful. A lot of that comes down to those lessons learned of seeing why other businesses are failing, and around setting up standard operating procedures and KPIs, or key performance indicators, right? And making clear, accountable goals and direction, and being able to hold people accountable, and just manage large scale projects with lots of moving pieces. I mean, I think that experience is critical as a syndicator, so I think those are two big things right there. I know I had a couple other differentiators that now that I'm on the spot, I'm blanking on a little bit, but I think one of the others was just around the type of product that we purchase. So we focus a lot on buying from mom and pop owners, really heavier value add deals with a lot of meat on the bone. So versus going out and buying like a 300 unit from another syndication group who has really squeezed the turn up on that, and really you're relying on market growth and rent growth at that point. We love to find properties where I'm closing on 2 properties in the next 20 days where the profiles are the exact same. They're long-term mom and pop owners. What I mean by mom and pop is it's somebody who maybe owns one property, who runs it as like a side gig, is not a professional manager, self-manages. And therefore, just usually those have a lot of meat on the bone, because it's just not a sophisticated of an owner. And so we're buying 2 deals. One, the guy literally lives on the property and has owned it for 15 years. The other guy lives behind the property and has owned it for 7 years. They both self-manage. And honestly, we can raise rent on both properties day one by $100, because they just haven't kept up with the market. And so they don't do other things like bill back utilities or allow pets and pet rent. There's a lot of ways that are just a lot of low hanging fruit where we can come in and just create tremendous value and give a better return than some of these larger deals. And those are really what we're focused in on. So I think that's a big differentiator as well.
Okay, that's really helpful. I just like to have examples and stuff like that. So I'm glad you went into that. And it's very interesting. So I know that you like to focus on these smaller ones. So what's like your minimum threshold? Because technically anything over, I guess, at or above 4 units is a multifamily commercial property. But what is your minimum amount to make the numbers work on each deal?
Yeah, so right around 30 units. So we've got a 30 unit in the portfolio right now. We're acquiring another 29 in 7 days. Um, you know, I wouldn't at this point. It's kind of 50 and up. I mean, those deals were both very special. It's tough the toughest thing about smaller deals is the management. One, finding good management, because a lot of the major management firms won't touch anything under 100 units because it just doesn't make sense for them with their overhead to do that. So finding good quality management and then coming up with a management strategy to be effective when you can't have on-site management, because properties that small can't bear the payroll load to have a manager on site all the time. So those are the hardest things to figure out on those properties. And at this point, for us, with size and it's just from an efficiency standpoint, it's about 50 plus units. So we're right in the 50 to 200 range is really where we're focusing. Again, we'll pick up a 30, but it's got to be a special deal. But anything smaller than that really doesn't make sense for us. Just because people don't believe me on this, but it is just as hard to buy, and actually harder oftentimes, to buy a 5 unit or a 20 unit than it is to buy a 100 unit property. It's way easier to buy a 100 unit property than it is to buy a small property like that. It's the same amount of work. And you just it's just less of a return for the same amount of effort, because you got to do the same steps.
Okay. Is that just in terms of like you're finding the debt financing for it and just making the numbers work overall? Just what do you mean?
It's harder to get financing on a 20 unit property than it is a 100 unit property. Less people will lend on that because it's a smaller loan size.
Yeah, I know a lot of lenders have like a minimum loan size, and it's just like, look, buddy, I can't even look at this.
Typically it's at least $1 million, if not, 2 million. There's not many that'll dip below $1 million.
Huh. Yeah, that makes a lot of sense. So if something's like 200,000 or 500,000 might seem like a lot to you, but for those banks or other institutional lenders, they need volume. That's really how they run their business, right?
It's the same thing for them, right? You think about it from their perspective. They got to do the same amount of work and due diligence on your $250,000 loan as they're going to do on the $5 million loan over here, or the $30 million loan over there. So it's efficiency for them too.
Yeah, definitely. But they make more interest, obviously, on a higher principal loan, like the 5 million versus $250,000. So
totally right. That's exactly what I mean. It's the same amount of work for, and they're going to get more return on the bigger loans.
Yeah. Okay. Very interesting. So I know that a lot of multifamily operators will source their deals through brokers, leveraging those relationships. Obviously, like on the larger ones where brokers could specialize in that. But what is your mix between like your own direct to owner marketing versus brokers and finding your deals?
Yeah, I mean, at this point, we're like 90-10. I mean, we still the main focus is on building long-term broker relationships. I mean, the brokers are great at what they do. They spend all day reaching out and getting deals to market. And so building those long-term broker relationships is absolutely critical. We have started a little bit of direct to seller outreach. The 29 unit I mentioned that we're purchasing was actually direct to seller. And that's gone extremely well. It's a difficult process. It's a high volume, low return type of investment. You send out hundreds, thousands of mailers to get, a couple people to respond to you. But I think it's an important piece of the equation. I mean, if you don't have that, then you're not doing all that you can to find all the best properties. Now, those deals typically take longer to come together because you've got to build a long-term relationship with that seller. You got to get that seller to know, like, and trust you, right? It's the same thing. And give them a reason to sell to you versus going to the market and selling with a broker.
Yeah, that's interesting. That's a really good point, because I mean, I know about establishing that rapport and building that relationship, but never really thought like they're also in a way investing in you, even though you're the one giving them the money. So they're kind of like just buying into the story of, yeah, I think that I want Mason to own this property and, kind of take over my legacy of the property, all that, right?
I mean, 100% right. Like that is what the rapport you're trying to build with a seller. Otherwise, why wouldn't they take it to market? And I mean, 90% they're going to get a higher price if it's a marketed deal where you have people in a bidding war against it, right?
Yeah, definitely. So you mentioned just a second ago that you may not have on-site management for your properties because there's smaller properties.
The smaller
So
properties we don't. The
yeah.
larger ones we do, yeah.
Okay, cool. So what's like the most effective way to manage it if you don't have the on-site management, and like how do you work in technology and all that? Is you just leverage different technologies, or how does that work?
Yeah, we definitely leverage technologies to help us be more efficient. So the way that you manage smaller properties is what I call like a scattered site portfolio, where you bundle properties together and say, okay, you've got a couple of properties here that make up maybe 80, 100 units. You can have one manager manage all of those properties. Same thing from a maintenance perspective. Have a maintenance team for all of those properties, so that you get to a unit count where you can support that payroll for those employees. And so that's how you manage it. You manage it in kind of a pod structure. At least that's how we look at it. And from a technology, and you do everything you can with technology to lower or to increase your efficiency and kind of lower the burden on the management, make it easier so that that manager can manage more units. Because the more units you can spread their fixed salary cost across, right, the lower per unit cost for your management. And that's how you build economies of scale. And so things that we do, things that we've done in the past are, put smart locks on the property so you can control access to the property and to units remotely. That's been not only a win for management, but also something that the residents have responded really well to and like. Another thing is putting cameras on the property. So we have, cameras on site that are recording, so you can get eyes on the property without physically being there. So I can look at a camera and say, or management can look at a camera and say, oh, there's trash out on that property. It needs to be cleaned up. We need to get somebody over to do that without having to drive through and check, is there trash on the property? And so those are big things. Other things are, allowing self-guided tours and virtual leasing. So virtual leasing, I mean, is extremely common now, especially through COVID. Being able to, really what that means is being able to sign up with a lease on your phone or computer, and then kind of through a DocuSign or something else, actually sign up for your lease. So you, again, don't have to be in person physically signing a lease. But the self-guided tour piece is something I think that is still under leveraged, but becoming more and more common. And there's a couple ways to do that. If you have a smart lock, then that facilitates it, right? Because you can let people in via the smart lock. If not, though, we've actually just used lock boxes, just like a realtor would use a lock box on a property, where you give the folks the code, and the code, you can change the code remotely. You give the people a one-time code, they open it, they go in and they can view the unit. But again, the whole thing about a self-guided tour, self-guided meaning no one's there walking them through the unit and the property, is that they can do it on their own time, on their own pace, without the pressure of having somebody following them around. I mean, we've all done that. It's kind of awkward. I've rented apartments before. And beyond the manager's schedule, right? People can come to the property and they can do that on their own time, especially if we don't have a manager on site. If you're requiring your manager to drive there, do the tours, it's very inefficient. There's an opportunity cost for what else they could be doing, right? And so that self-guided tour piece, I think, is huge from being able to leverage, better leverage offsite management.
All right. Yeah, that makes a lot of sense. And that's something I never really thought of, but that makes total sense. It's really scalable, like beyond their time, like you said.
Yeah, exactly.
Okay. So I know you say there's more meat on the bone for these types of deals, get a higher return. So a lot of deals are underwritten to expect like an 8% preferred return and all this. So what's your typical return profile on your deals?
Yeah, I mean, it's a good question. So from a deal structure standpoint, a typical deal structure would be a 7% preferred return and a 70-30 split above the preferred return. So essentially what that means is the first 7% goes to the investors. And then above that, and that's annually, and then above that, is when the sponsor starts to get paid. So above the 7%, then we start to split the returns. 70% goes to the investors and 30% goes to the deal sponsor. And so that preferred return, while not guaranteed, is preferred. It's higher on the capital stack. And so that it kind of gives the it's beneficial for the investors because they're getting at least that 7% before me as the sponsor starts to get paid and start to realize value out of the deal. And so it's an incentive for me to work above and beyond, right, to be able to get to that point. And so that's how our deals are typically structured. We keep it really simple. We don't do IRR hurdles or different things where some examples could be like, if you get to a 13% IRR, then the returns split to 50-50 instead of 70-30. We just keep it real simple at 70-30 all the way up because, I started as a passive investor and I always hated the deals where the waterfall structure was so complicated. It was difficult for me to do my own math and figure out what I should be paid. And so, I never want to be in that position with an investor where they think they're owed something else and my math is something different. And it's not a conversation I want to be involved in. So I just try to keep it really simple so everybody can do the math themselves and know what they should be receiving. Now, that's kind of how the deals are structured. Typical returns you can expect. It's tough to say typical, but I can tell you my criteria when I'm underwriting deals is that I want to see a 15% IRR over a 5-year hold period. That's like my minimum baseline to know that I want to go after a deal or not. So typical returns will be somewhere in kind of the mid to high teens from an IRR standpoint. And IRR is an internal rate of return. It's kind of an overall return metric that takes into account time value of money, which essentially just means that $1 in 5 years is worth less than $1 today. So it discounts your future cash flows the farther it goes out. I think it's really important when you're looking at real estate deals because cash flows don't come in evenly across a 5-year hold period. You're not getting the same amount in year 1, year 2, year 3, year 4, year 5. You're typically getting 50 to 60% of your total return at sale through the appreciation on the sale. And so the reason an IRR is more accurate than just doing an annualized or a flat average is because of how the money's coming. You're getting a huge chunk over here and that it kind of smooths it out over time versus just expecting, you're going to get 20% year 1, year 2, year 3, year 4, year 5. So I know it can be a difficult concept to understand. I try to say it as simply as possible. The whole intent is it's a more accurate, I think, measure of your return based on when you actually get the cash. And from a cash on cash standpoint, which is the return that you're getting for us, we're distributing quarterly, which is your share of the profits as an investor. That typically falls within about the 8 to 10% range. It starts out lower and then goes up as we, increase rents and realize and decrease expenses and improve the operations on the property. But we end up typically in the 10% range toward the end of deals. And from one of the easiest things to understand is I want to target about a 2x equity multiple, again, over a 5-year hold. So in 5 years, what that means is I'm trying to double your money. And if I can double your money in 5 years, then I think that's a successful deal from a baseline standpoint. Then hopefully we can always under promise and over deliver. But those are kind of the baseline metrics that I'm looking at as I'm evaluating deals and deciding whether or not I want to move forward with them. Because I know those deals are going to be attractive to my investors.
Okay, that makes sense. Yeah, you just have to have a baseline just to conservatively underwrite something, and it might turn out better, but at the minimum, you have to have that. So that makes a lot of sense. Yeah, and it's kind of in line with other deals I've heard. I know that you have to obviously have like a syndication attorney on your team to prepare the legal documents and everything. Is that something that they have to do on every deal, or is that something that they do on like your first deal and then you can largely recycle those documents? How does that process work?
No, it's something you need to do every deal. You don't want to mess around with that.
Yeah.
You don't want to mess around with getting sideways with the SEC. Just spend the money and get your documents done and get them done the right way and get them done for the specific project.
Yeah, that makes sense. It's kind of a silly question. I'm just curious because certain things like you just copy the file and then you just change out a name and then it's like, there we go, we're done.
Right. And and how much do the documents really change over time? Yes, technically you could, copy paste, probably do that. But for me, it's not worth the risk. I want to have that attorney on my side thinking about, the pros. And every deal is a little different. And so you want to have them thinking about, what's the specific deal? What are the different things we need to do? How do we make sure we're protected? How do we make sure that we are? One of the biggest pieces is just making sure that you are accurately portraying the investment to the investors. And as long as you're doing that, I mean, that helps you just stay on the right side of things. And so, that's one of the reasons why you can't just copy and paste that. At least I would highly recommend not just copy and pasting that stuff.
Yeah, that's the other thing I was thinking as I said it, is every deal is different too. Even if it's a nuanced difference, it's pretty important to have those differences.
Yeah.
outlined.
And I mean, I think that's just like, just doing the right things the right way. Like if you're going to, like, for me, I take it very seriously that I'm taking other people's money, and our minimum investment is 50,000. So I'm taking a significant amount of someone else's money, and they're trusting me that I'm going to do things the right way to be able to return the investment that I've promised to them, right? And things like bad paperwork, I mean, and not doing things the right way can have nothing to do with the performance of the apartment, but throw the deal off and have that investor lose their money just because the sponsor was lazy, And so those are things that we just don't, we wouldn't even consider.
Okay, great. I know you hit on it earlier about ways to increase your profits without increasing rents, but could you go into that a little bit more about how to increase NOI?
How to increase NOI without raising rents?
Yeah, yeah. Just baseline. I've heard a few of our guests on our show have discussed what they do, but I'm just curious what you've done to do that.
Sure. So aside from raising rents, and this is actually another differentiator that I brought up with that investor that I just thought of is the fact that a lot of our business plan is, we really have a heavy focus on creating additional revenue streams on our properties. So raising rent is great, but you can only raise rent so far. Especially in our deals, which are, very much workforce housing, deals with folks that are largely making anywhere from, 40 to 65,000 a year. They can only take so many rent increases. So other things that we'll do are, things we mentioned earlier, like bill back utilities, which is very common in our, it's market specific, but it's very common in our markets that residents are responsible for their own utilities. Allow pets on the property and then charge a pet rent, if you will. People are very happy typically to pay $20 to $35 a month to be able to have a pet. And it also, if you look at the number, it's something like a third of people have dogs. And so it opens up your tenant base quite a bit too, if you allow pets. Other things we do, one of the ones that I'm most excited about is we've developed a relationship with a local company here in town, which is a fiber optic internet provider. And we're installing fiber optic internet on all of our properties. And we become the internet service provider. And I love this one because it's a win-win for everybody, because the resident is already paying somebody for internet, right? Almost everybody has internet. And we're able to come in with a better product because it's fiber optic. It's more steady, it's higher upload speeds, typically better download speeds too for same or cheaper price. We do a market survey. We undercut the competition by about $10 or so. So we're lowering the overall financial burden for the resident. And we're still able to make, it's typically $30 to $40 net profit a month per unit from kind of buying wholesale and selling retail for the internet. And so it's been an incredibly successful program that we've implemented. And I love it because, again, it's not an additional financial burden for the resident. So that's one that I'm most excited about. Other things we've done in that way are like rent back washer and dryers. So actually purchase the washer and dryers and then rent them back to the residents. If there's washer dryer hookups, not if it's a laundry room. Then there's parking. We've done some storage. like renting self-storage to folks on site, different things, different ways to create income. You can create a substantial, you can really move the needle on your property through other income if you really focus on it.
Okay. Yeah, that's really interesting. I haven't heard of the internet idea yet, but that sounds just great. It's really interesting. And also the washer dryer thing, it's a good idea if they exist. Like I know that a lot of them have laundromats, like you said, so just depends. Go on.
Oh, no, it depends. It mainly depends on the vintage of the building. You know, if it was built in the 70s, it's highly likely that it doesn't have washer dryer hookups. It's built in the 90s. It's pretty common.
Right. Yeah, I remember when I lived in New York for like 6 years, and those you have the water towers on top because you have to use gravity to get the water down, because water, our super is telling us that water can only go up like 4 floors from like the ground pipes, stuff like that. So it also definitely depends there. I mean, those buildings are like 100 years old often, like pre-war is in like before World War I. So a lot of those don't have like in-unit washer dryer as well, for I think just for physical reasons and infrastructure, like you said.
Yeah, and just age of the building, right? Like they didn't have washer dryers when a lot of those were built, or they were. So, well, a
Yeah.
lot of what we're buying though is very different from what you lived in New York. What we're buying is very much suburban garden style apartments, typically 2 stories, you know, longer than they are taller. You avoid a lot of cost if you can avoid elevators and things like that. And so it's very much kind of a garden style suburban property.
Okay. Yeah, that's a good point. Elevator maintenance and other stuff like that could just definitely be a headache. I had a friend that lived in the I forget the name of that building. It's like this giant needle in Dubai, and it's like 180 stories or something like that. And he said one day the elevator went out, and just imagine like in the world's tallest building, it'd be quite kind of a nightmare.
Yeah, that's good exercise, right?
Yeah, I mean, won't we do anything else though except walk down those stairs or up them? I remember actually the first apartment I lived in, it was like 30, I lived on like the 32nd floor, and one time the elevator did go out and I did walk up like 32 floors. It was quite a workout, but
I bet.
yeah. So we've hit on most of our questions, but I did notice that you worked at this real estate private equity firm called Burge and Held. I guess that was around 2019. That was after you had sold your consulting business. Could you go into that a little bit more? Because I feel like a lot of people don't uncover the more institutional side of things. Like, what was that like, and how'd you leverage that experience to your using in your business now and all that?
Yeah, that's a good question. Yeah, I spent a little over a year there. Really, so Burge and Held is they're based in Indianapolis. They've got about 15,000 units, about 1.5 billion in assets under management, and it's actually owned by a guy that's been a mentor of mine since about 2016, and it was one of the first firms I started passively investing with back then as well. And so just through building that relationship and kind of having that mentorship, and then as I started having success on my own as a syndicator, you know, he approached me and said, you know, why don't you come and join us, you know, join us as a partner, start a line of business, focused more on, I mean, they were pretty much 200 plus units up, big properties, sourcing a lot of their capital from institutional investors. And so the idea was for me to come in and focus on kind of my niche, those smaller properties, raising money from individual investors, bringing in a new equity pool, and be able to just kind of differentiate a new strategy for them, right? And so it came in and started the business line, and went through 4 transactions with them, 4 purchases. And it was an amazing experience because I got to see inside a very highly successful firm, kind of what they do, what works, what doesn't work, like what to do, what I would want to take away, what I wouldn't want to take away, understand a lot of the best practices and things. And I think it was just a great mutual exchange of value for about that year. You know, I was able to help them renegotiate a contract for one of their largest contracts and save them about $600,000 a year just from my past consulting experience negotiating contracts. So I was able to provide value in that way, and they were able to give me a ton of education while also, you know, getting a lot of experience as a GP on 4 deals. and really get started. Or really kind of, hit, like I'd done a syndication prior, and then, get to 5 all of a sudden. And then you really start to know what you're doing. And so it was a great experience. I look at it as kind of like my real estate MBA, if you will. I had never had formal training in real estate. I started out with podcasts and books, moved on to training programs, online courses, went through a couple mentorship programs, but never really had a formal training. So going there was really, kind of the next level of experience, I think. And really, I guess another great differentiator in my skill set. And so I've looked at my career as these ways to continue to build my education and build my knowledge. And I keep finding these opportunities to do that. And Burgeon Held was another great one. So yeah, I really am thankful for them and what we were able to do there, and still a lot of good relationships there. I think the other thing it did was open up a ton of networks for me and make a ton of connections that have been extremely valuable as I've taken the business and now I'm in building my own business, much in the very same vein.
Okay. Got it. Yeah, I'm just curious. I have a college friend that's working at a real estate private equity firm in, I guess, the Philadelphia area. And he was saying his goal is to eventually become a sponsor on a deal, just basically exactly like what you explained. But at the same time, I feel like I'm kind of on the fence about it. It's like, should I interview with his firm or one of his past firms? He said he could get me an interview at this other firm in Dallas, and maybe I should consider that path. Or I could just like focus on building my own real estate business. So I'm just wondering, do you feel like that's a necessary prerequisite to work at a larger firm? I mean, it's perfect if you have the time, but if you already have like a business in place and a plan in place, then do you feel like it's necessary, or what do you think?
Man, I think everybody's different, right? Everybody's at different places. Everybody has different goals. It's tough for me to say, having us just met, but it was extremely valuable for me from both a network standpoint and a knowledge standpoint. And I think it's something that if you can do, I mean, there's not a lot of downside to doing that. I think for me, the reason that I ultimately decided to leave after, a little over a year versus staying for 5 years was that I felt like at the end of the day, I'm an entrepreneur at heart, and I wanted to build a business that I wanted to build versus building somebody else's business. And the work that I was doing and starting a business line there was really doing the same actions I would do to build my business, but really within somebody else's umbrella. And I think in some ways there was just this kind of rub of kind of trying to start an entrepreneurial culture, this little unit within a much larger corporation, and there was just some friction there in doing that. And so for me, the decision was, it was a great learning experience. I think both sides got value out of it, but at the end of the day, I wanted to be out on my own, building my dream and my business, and going after the deals I wanted to go after, and having the leeway to go after any deals that I wanted, not just kind of, within my pigeonhole, and also be able to raise money, focus on raising money from the type of investors that I like to raise money from, which is really individual people who are, trying to get out of the rat race, or trying to get cash flow for retirement, or trying to just get a better return with less risk than the only thing that's ever been offered to them, which is the stock market. So I really like those individual stories. That's what makes me excited and like gives me passion, is being able to see the ability to change people's lives in that way versus, raising money from a large institution, which is just, kind of working business to business. And you just don't get that. I just don't get that same thrill from that.
Okay, got it. Yeah, I didn't mean to seem like I was looking for some life advice. I mean, my decision's already made. I was just kind of speaking as an example to listeners, but maybe there's someone else out there thinking like, should I go that route and get that experience, or is even required? But I totally agree. It really comes down to your own personal timeline and situation, and what you think is best. And honestly, like
it's not required, but it's also not going to hurt, I mean, getting an extra level of education, I mean, it definitely isn't going to hurt.
Yeah, exactly. Just the only thing I tell myself is like, I look at my friend and I don't really know what he's done. We're not like super close, but my assumption is I've taken tremendously more, exponentially more action than he has in getting to his end goal of being a sponsor in a deal versus what he has. Because in my mind, if you're in that environment constantly, like you're never going to really get out unless you start doing stuff, taking action, being an entrepreneur, and starting to build your business. So that's my worry is like, well, if I start interviewing with other firms and I'm just going to get stuck in the whole loop again that I'm trying to escape, the rat race, as he said.
Yeah. Yeah. And I think that's a real consideration. Definitely.
Yeah. Okay, perfect. Yeah, I guess the other last question is, do you ever raise deals for other people, or raise capital for other people's deals, or is it primarily your deals that you're working on?
Yeah, really just my deals. I really don't focus. I had to make that decision, which path do I want to go down? I mean, there's a lot of people that do really well raising money for other people. At the end of the day, I just don't like putting my fate and the fate of my investors who trust in me into somebody else's hands. I want to have control of that. I want to know that the right steps are getting done. I want to know that they're looking at the right things. It's really hard for me. Like I said, I take it very seriously to raise money from others, and to take that and then turn that over to somebody else, but have my stamp on it is that's just difficult for me. It's not. Yeah, it's not for me. I need to know that I've got control of the deal and that the right things are getting done at the end of the day. If I'm gonna put my stamp on something.
Okay, yeah, it totally makes sense. And everyone's got their own different business model. And I know we had our last guest was talking about running his business with him and his brother, and just kind of their situation in their life, still working some like their job and taking care of their family and everything. It just was easier to scale, like raising capital for other people's deals. And it's just like a different business model altogether in terms of like being the go-to source for pre-vetted sponsors and just consistent deal flow and all this different stuff. So it's just a different thing, but totally understandable. Those great arguments on both sides. Just depends on your situation again, like we just discussed. So is there anything else you think we've left out here? Are we about good on everything we covered?
Yeah, I mean, I think so. I think we had a good discussion. I think, my main point is I want people to know that these type of investments are available, because I mean, they're still not broadly advertised. Everything you see on TV commercials or even hear from your employer is, you got to invest in the markets. You got to sock money into your 401k. And that's the only thing that we ever hear, and we're kind of indoctrinated with. I just want people to know that there are other options out there. And frankly, other options like real estate investing can make you a whole heck of a lot more money than doing the traditional route. And money that you can spend now, money that you don't have to wait until you're 60 to start to be able to access at the point where, if you want to go travel around the world, like, it's a lot better to do that when you're 40 than when you're 60, just physically, right? I mean, you get to the point where you can start to spend that 401k, and a lot of people are in a position where they don't want to or aren't physically capable to do that stuff anymore. So my whole thing is there's alternatives out there that you can access and give you access to your capital sooner, give you better returns. And I think overall it's a better risk adjusted return. And that one of these apartments, the type of deals that we do, like I said, they've been cash flowing for 30 or 40 years, and we're just helping them make a little more money. They're not going to just lose 40% of their value in one day like a stock can. And so, not that you should put all your money in real estate, because you got to diversify, but there's a place for it in everybody's portfolio. I mean, if you look at the richest people in the world, I've seen different reports, but everybody's pretty much somewhere in like 20 to 40% allocated into real estate. So the thing that I ask people is, like, if you're not investing in real estate, well, if it's good enough for the 400 richest people in the world, like, why isn't it good enough for you? And I think it's just a lack of knowledge and a lack of access, and just kind of this perceived risk, because it's just unfamiliar. But it really is, if you're doing it the right way, it really is just a perceived risk. And as you understand it, the light bulb will go off and you'll get it, kind of just like it did for me. So that's what I want to get across to people. Beyond that, I'd say I'd love if people would check out my podcast. It's Ritter on Real Estate. The tagline is passively invest like a pro. So it's really about me interviewing the pros to teach passive investors how to be better passive investors and how to make better investing decisions. We talk about vetting sponsors and markets and all that good stuff, right? And check out my website. It's kentritter.com. And it, again, is really meant as an investor resource. So there's a blog, there's videos and other things there that folks can check out to, again, help them be better investors and make better investing decisions.
Okay, perfect. Yeah, I noticed there's a contact form on the website, but if someone wanted to directly contact you more easily, you don't leave an email or anything like that?
Sure. Yeah, you can contact me. I mean, my email is kent@hudsoninvesting.com. Really, which you can definitely reach out to me. I've set the website up in a way to just make it easier for folks. So if you go to the website and you fill out the form, it's going to give you a Calendly link where you can just schedule a meeting right on my calendar. And honestly, that like Calendly is like the best tool of the past 10 years, where it just allows you to schedule on times where I'm available. So you can pick a time that works for you. You know, I'm free. And it automatically gives you the Zoom link to do that. So we can easily get on a call. So, go to the website and do that. If you don't want to, yeah, reach out to me via email. I'm also very active on social media. You can find me, Kent Ritter on LinkedIn. It's Ritter on Real Estate on Instagram, but, DM me and be happy to connect. I mean, I like at the end of the day, I love talking about real estate. I mean, that's why I do all that I do. That's why I come on these podcasts. So the more that I can do that, the happier I am.
All right, perfect. Well, definitely learned a lot of good stuff here. I'll include all that information in the show notes, but for the diligent folks, maybe they've already written it down. But thanks again for taking time to get on here, and look forward to having you again in the future.
Definitely. Thanks, Mason. A pleasure to be on your show.
All right, that's another episode of Scalable Real Estate Investing. Thank you for tuning in. Please be sure to leave a review and subscribe on whatever channel you're using to listen or watch these episodes. And also be sure to go to scalablerealestateinvesting.com, scroll to the bottom, and fill out the form to sign up for our email. And you could also reach me directly at mason@scalablerealestateinvesting.com. That's MASON at scalablerealestateinvesting.com. If you'd like to get in touch with me to either partner on deals or even be considered to do your own episode on this podcast. Thanks again, and have a great day.